Good afternoon, everyone, and welcome. I'm Katrina Radenberg, Chief Investment Officer of Mariner Wealth Advisors, and I'm here with my colleague, Jeff Krumpelman, the Chief Investment Strategist and Head of Equities. It's that time of year again to pause and reflect on what has happened in the first half of the year compared to what we expected, and to update you on what we expect in the coming months as we move to close out 2022 and move into 2023, as crazy as it is to think about the year being half over. I'll set the stage for us today and begin today's presentation by providing a quick overview of 2022's first half and key happenings in the period. Then I'll bring Jeff in so we can have a conversation together regarding the current issues and concerns on investors' minds, and importantly, our conclusions on these fronts and our outlook going forward. So first, in terms of an overview, I think we all appreciate the fact that the markets weren't very kind in the early goings of the year. In fact, I believe it's fair to say we can do without another 6 months like those in the first half of 2022. It was ugly and it wasn't fun, but after an impressively profitable 3-year stretch in 2019, 2020, and 2021, it also wasn't a total surprise. In June, the S&P 500 declined 10%. This lousy experience in the final month of 2022's first 180 days helped make Q2 of 2022 the worst quarter for U.S. large cap equities since the pandemic-stricken Q1 of 2020 that included the 35% intra-month swoon in March of that year. You can see on this slide that on a year-to-date basis, the S&P 500 is down approximately 20%, representing the worst performing first half of this index since 1970. It wasn't just U.S. large cap stocks that suffered either. Pain was really broad-based. As you can see, investment grade bonds fell 11% through June 30, thus posting their poorest start to a year in history. Equities and fixed income securities in emerging international markets declined, and cryptocurrencies were cut in half or more. The culprit for these various asset classes taking it on the chin, particularly when focused on the U.S. stocks, wasn't simply a "we're due" emanating from the robust returns from those prior 3 years. That's part of it, but the primary catalyst for the timing of this correction were the many transitions going on in the economy and the financial markets this year, from the V-shaped economic recovery following the peak in COVID spread to something slower, from Fed accommodation to something more normal and cautious, and from abnormally low inflation to a more probable, normal, higher rate of inflation after things settle. It was news on these latter two issues, the inflation and the direction of the Fed policy in June, that really spooked investors and inspired a sell-off going into the locker room at the midway point of the year, and that conjured up these undesirable titles for the market so far this year. Specifically, the headline CPI figure of 8.9% was released on June 10th. Not only did investors react negatively to that data, but this also woke up the Fed in a big way in the meeting that they had the following week and motivated them to hike the Fed funds rate by 75 basis points when they adjourned, rather than the 50 basis point raise they had anticipated employing prior to that June 10th CPI data release. These two news items really cemented in investors' minds the fear that we are likely to experience a hyperinflationary environment like that of the 1970s, which could cause the Fed to raise rates very aggressively to slow inflation, as well as the economy, and spark a serious recession. Economists surveyed recently by the Wall Street Journal place an average 49% probability on recession occurring in the U.S. in the next year. And our own chief economist, Bill Greiner, just actually increased his probability of recession from 40 to 50%. So Jeff, now that I've put everybody in such a good mood by recapping the unpleasant historical overview, let me bring you into the conversation, and perhaps you can lift spirits a bit. So specifically from a financial market standpoint, what is our perspective on the state of the union at present?
Yeah, sure, Katrina. And I guess I should start by saying if your preface or introduction would be judged by what you've done to set the mood, as a warm-up band, we're in trouble here, but you didn't have a lot to work with. I mean, it really was a very challenging first half. There's no doubt about it. So I do have some good news to lift the spirits maybe a bit, just to start before I answer your question. But we did look at history. And if you look at the prior periods, I think there are about 5 different years through history. And I wrote them down: 32, 1939, 1940, 1962, and 1970. And in each of those years, when the market fell more than 15%, those were the years where that happened in the first half. The second half was really good. It was up on average about 24%. So we're in no way predicting that that's what we expect to happen. But I will say, as a preface, when we sit back and we look at the fundamentals of the economy and the market, the valuation levels, and the technical, both price trends and just general sentiment, when you look at those 3 levels, we think that we're closer to the bottom than we are the top. And we do think, again, as a commercial, an executive summary, that we very well could see higher highs in 2023 and certainly have significant upside as we move into next year over the next 12 or 15 months. So I'll start off kind of on a good note after that little, discussion of the first half. I think, though, to more directly answer your question about how does rising risk of recession and the elevated level of inflation impact our view on performance in the capital markets going forward, say a couple things. You even said in your introduction that economists who, and this would include our own, Bill Greiner, who make a business of looking at recession and the risk of that, the average probability that they assign economists as a whole out there, according to Wall Street Journal poll, is about 50%. Let's remember that means there's a 50% chance that we won't have a recession. So I think it's key to start by just saying that. And importantly, while risk is rising, the 4 key criteria that we look at to make that call, these criteria that signal impending recession, and they include: 1 is the yield curve inverted, both the 2 and the 10-year and the 3-month and the 10-year. That's one factor we look at. We also look at the activity surveys in manufacturing and service companies. Are they signaling growth or decline? We look at the level of employment. Is it low or is it trending higher and high? And then we look at the trend in leading economic indicators. And let me just tell you, none of those are signaling red. Several are signaling yellow, but none are red. And so it's premature actually to make that call right now. Now, having said that, and kind of putting the economist hat on, let's switch to what the stock market thinks. And clearly the stock market thinks that we're going to have a recession. And that is illustrated in the fact that we did fall to the low on June the 16th, only a month ago, by 23%. And now we've had, a week and a half of kind of good stuff, and we're back into the high teens that we're down for the year. But whenever you pierce that more than 20% down, folks start saying, well, that's reflective of a bear market. So the stock market is concerned about this. To that, we would say, the stock market gets that right about half the time. There's a reason why Paul Samuelson said the stock market calls 9 out of the last 5 recessions. And he said that back in 1960. And in the recessions that ensued since then, the stock market's been right about half the time. So you can't, put all your eggs in the basket of the stock market is getting it right. And just to put some meat to the bones on that, think about 2018. In December 2018, the market was down 21% in that month alone, intra-month. Everyone was very crabby and concerned about tariff rhetoric and the Fed making policy mistakes in their shift in policy. And that should sound pretty familiar. And the yield curve inverted for a nanosecond, for about a day, and then it uninverted. We didn't have a recession. the fundamentals, the valuation levels, the technical trends were all healthy. And boy, oh boy, did we have a great 2019. The market was up over 31%. So again, we're not making the call that we're going to have that kind of robust performance over the next 12 months. But, the stock market got it wrong. Now, you can contrast that to 2020, where the stock market got it right in that it felt like we're going to have a recession. And we did. It was a forced economic shutdown recession. And the S&P fell 35% in the month of March alone. Yet, the stock market also, which is forward-looking, saw that we were going to get this uber stimulus package and that we were going to recover from a V-shaped, or from just a huge, almost depression-like swoon. We were going to have a V-shaped recovery because of all this money through the various programs that were being thrown at the economy. And indeed, that is what happened. So here you have an example where within a short period of time, in one case, the stock market got it wrong. In the other case, it got it right. So 50-50. But what the stock market has in common in both of those periods is that it looks at where it thinks the puck is going, not where it was. And just by saying we were down 23% as of June 16th, that's rear view mirror looking. So what do we see that is forward looking, that's trying to assess where the puck is going? And I think the key things that we're focusing on are inflation and this risk of recession, and they're intertwined. We see positive news on that front. We see positive trend. You read the headlines and they have you think that we're at 4-decade highs in inflation and things are getting worse. When we look at, as you'll see, and we get more detail, trends in commodity prices, trends in wage growth, trends in core inflation, it's actually getting less worse. And that's how bottoms are formed. Things don't get absolutely good. They get less bad, then they get okay, and then they get good. And we think we're along that trend in a nutshell. So that's why we think we're part of the reason why we're closer to bottom.
Thanks, Jeff. Clearly, you touched on quite a few points and items that I do want to bring us back to in a bit. But at this point, I think what would be helpful is if we focus on, the message and what the message was in the midst of these performance challenges in the first half. So perhaps now you can articulate our message about kind of what we got right and what we got wrong.
Right. So we always want to be very reflective and think about, what's happened in the market and also what our message has been within that. And there are some things that I think we did well last year, or in the first half of this year, sorry. And you see that on this table. So we did, going into the year, forewarn, and we were pretty specific, said not only do we expect a correction, it wasn't the typical rhetoric of, should expect a correction at any moment. We really said we expect a correction, and probably a more significant one, somewhere in the magnitude of 15 to 20%. So like I said, we were down 23% as of June 16th. Now we're down in the upper teens on a year-to-date basis in terms of S&P 500 decline. So I think we're pretty close to that. It did get a little heavier than we thought, and we could see the S&P 500 fall a little more than what we thought before all this is over and we're in good footing, because there's so much psychology involved here. But we did say, hey, be prepared, steel up. We also said, as a result of that, we didn't say sell, 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 but we did say it would be prudent if you are above your normal long-term targeted stock allocation, because the S&P is up 26% per year over the last 3 years. We've had this beautiful history and period of making a lot of money in stocks. Maybe it's taken you to 70% and you're normally a 60% stock investor. Cull that back to 60. Go back to your normal long-term allocation. And that will prevent the regret from not taking action, feeling greedy, and it might give you the courage, if we do have a greater than normal correction, to step in and add to that allocation at the right moment. So I think we feel pretty good about that. We had solid stock selection in our internal strategies, and in the majority of the case of the internal strategy that we run, we outperformed the market. We went down less than the S&P 500. So I know you're not standing up and say, hey, way to go, man, you're only down blah. But it does help when you go down less. And we did that through good stock selection. I put this in here. We did it through a balance between growth and value. That also can be a nit because we did feel like you should hang in there with growth. I'm glad that we had that thought because if you look over the last month, that's what's leading again. And we do think we're going to get that rotation and that's going to work out just fine. And you can be selective on what you own within growth. There are different flavors of growth that you want to own and those that you don't. And we can get into that. But we also said large cap over small. And that certainly was the case. Now, we weren't we were not perfect. And there were things that surprised us. And I think it was the three, they're all kind of interrelated here on the right. We really did think that once the economy could reopen and some of the stimulus programs expired, that you'd see people come back into the labor force and that it wouldn't be as tight as it is and that wouldn't push wage growth as high for as long as it has. So I think we've missed that, but we're starting to see that ebb finally. Inflation, as a result, was stickier than we thought. But we have to remember, we're coming out of a pandemic that we've never seen before, that we haven't seen for 100 years. And as a result, you had supply chain bottlenecks that were just more difficult. And it was a rolling kind of pandemic thing. But it has been stickier. Again, we see signs that inflation is getting less worse. Maybe not as fast as people want, but signs that it's moving in the right direction. And as a result of those first two factors, the duration of the correction was longer than we thought. We've gotten spoiled, and we've seen in the past that, man, it's 2 weeks, and then you want to get back in. And on that front, I think that we have had a good message in which we have said, okay, we've not gotten it perfect. This has inflation extended a little bit longer than we thought. But you know what? As a result of this, do not buy in the dip. Cut back to that from 70 to 60. Don't sell down below that, but also don't aggressively come in with excess cash or increase your equity exposure above that long-term target. So net, I think we feel pretty good and recognize that this tries everyone's patience, but that's part of success in the market. Patience can be a real virtue at times like this, where maybe people are overreacting.
Yeah, all really good points. So basically, we anticipated a sizable correction, but felt it might dissipate rather quickly, like other rough patches we experienced in the post-2009 bull market advance. We felt it was quite reasonable to think we'd see labor force growth and supply chain improvements as global economies reopen, but recovery from and aftermath ramifications of the pandemic have clearly taken longer than we anticipated. So incorporating the more stubborn challenges, where do you see things headed as we move toward year end and on into 2023?
So we've got a slide that will help guide us through this. It's actually it's not a really busy slide. It's pretty simple. And this lays it out. So you've got a table that tells you our targets for the S&P 500. We assign probability to different scenarios, and you get a sense from the probability where our conviction is. And then up above, we describe the environment that we expect to drive that base case or better scenario. So let's focus on the green, the base case. We assign a 60% probability that the S&P 500 will trade 12 months from now, mid 2023, at 4,500. And the environment that describes that would be one of deceleration in GDP growth, probably in the positive area, a range of -1 to +2, but we lean towards positive GDP growth, positive earnings growth, and inflation calming, that rates will peak somewhere around 325, maybe 3.5 on the upside, and then begin to stabilize and fall. So that's kind of base case. And if that happens, we think that we'll get just a little bit of multiple expansion. Multiples have come in from 22 times to 15 or 16 times. We think that investors seeing evidence of this stuff easing will bring some cash into the market. Multiples might lift to 18 times, and that earnings will just be kind of high single digit in terms of consensus earnings growth. And that delivers 20% upside from where we are today, which is significant. There's a chance that maybe inflation will calm more quickly than we're expecting right now. And the economy is already starting to slow. Housing's starting to slow a little bit. And I say that in a good way. We needed to see demand soften just a bit. And as a result, perhaps earnings are just a little bit higher as inflation eases off and costs get more under control more quickly than we think. And you get a little higher multiple, not 20 times like we saw last year, but maybe up to 19. And then you get a 5,000 handle on the S&P 500, which is very nice price gain from here. And that would be an all-time high in the S&P. The all-time high is somewhere that's north of where the all-time high has been so far. Now, we could see a disappointing case, and we assign a 20% probability that we really go nowhere, that we kind of end things just about where we're at. What would happen in that front? Well, that would be where inflation just doesn't calm. It does not move significantly up from here, that we have a recession that's not horrible, that earnings are a little bit lighter, and maybe we hold the PE that we're at right now. They've already shrunk significantly and we hold a PE of about 16 times on lower earnings. And that gives you no growth. That's a boring kind of situation, but it's not tragic. And then we do think there's a pessimistic case where you do have a recession. And there we see 10% downside from here, which is not uber excessive when you look over the next 12 months. The market, as I said, is already off 20%-ish. And at one point, it's had more than that. It already is expecting a mild recession. So maybe we'll have one that's a little more than mild, and we've got additional downside. So that's kind of how we see it. But as a result of the trend that we see in supply chain bottlenecks easing a bit, inflation easing a little bit, the Fed, we don't expect worst case outcomes that are kind of built into things as we stand today. We think that can give you nice lift.
Thanks, Jeff, for laying that out. And just to remind everyone, this really is the view on the market over the next 12 to 15 months based on our research and assessment of the current fundamentals, technicals, and valuation levels that trends that we see right now. I'd like to take a minute just to kind of remind everyone, looking at this other slide, that we have seen plenty of 12-month periods in which the S&P 500 has had sizable intra-year corrections. So as you can see on this chart, those are depicted by the red dots in the slide, yet still finish the year in positive territory. So in many cases, unless the data is clearly negative, it's really best to stay invested and avoid that whiplash and then the wealth destruction that's seen from making moves like that can really result from turning negatively prematurely. So always like to throw this in here. Those of you that have been tuning in for a while know that this is probably one of our favorite slides to continue to put up here and hammer home.
And the only thing that I would add to that, Katrina, is the one thing I would add to that is that I recognize that everyone listening in, I think it's trying our patience here, that we've become so accustomed to. We've had beginning in 2009. Again, you get these periods where you see corrections and you see red dots in prior years where you're down in the teens on an intra-year basis. But man, you come back like right away. And then just think of 2020 down 35% in the month of March in 3 weeks, and then you come right back. Yeah. So we understand that can try your patience, but this is where I think it really pays to look at the real data and not just the headlines. And that's what we try and do. What we'll try and lay out throughout.
Well, yeah, no, it's a good point. Even if you just kind of look across at some of them that are hitting the double digits, they're double digits the other way,
Right.
On the year. So good points. So you've mentioned several times that based on current economic and financial market metrics, we feel that we're closer to the bottom than to the top.
Right.
And many experts cite the fact that the market declines on average by 40% in bear markets. Talk about why you feel the worst is likely behind us if historically the average decline in bear markets is 40%.
Sure. So we do have a slide on that, and this might be helpful. I think first point I would make on this is that I do hear a lot of peers just make general comments, and if taken out of context, it can mislead clients, investors, and they'll say something like the average bear market peak to trough declines are 40% in the S&P 500. They last 20 months, and earnings fall over 30%. So that's true if you look at all bear markets, but it's heavily influenced by just a few times in history. And I think it's important to know your environment whenever you're talking about, a bear. Is this a deep correction? Is this a bear? Whatever. And so on this page, you can see all the bear markets going back to 1929. And if you look at just those in 29, 37, 73, 2000, 2007, that's 5 periods in 100 years ish, where it was tragic. It was awful. And you've got the Great Depression in 1929, where we had food lines and darn near 20% unemployment. 37, we were still trying to climb out of it. And it wasn't until World War II that we were able to get out of that hole. But these are extreme periods. And then in 73, you had massive inflation, far higher, longer than what we are seeing today. In 2000, you had the tech bubble that was awful. And you can see these percent declines. I mean, in 29, the S&P fell 86%. In 37, 60%. In 73, almost 50%. And then in 2000, almost 50%. And then in 07, that was the Great Recession, the housing implosion, where we almost lost all of our investment banks. And that doesn't describe what's going on right now. We have 3.6% unemployment, consumers still spending. We've got more openings than we have people to fill them. So that's not descriptive of these other horrible periods. So if you just for a second humor us, exclude those, and look at normal mild recessions, all these other periods, the peak to trough decline in mild recessions on average is around 28%. And I just mentioned earlier, we were down 23% as of June 16. So we've felt most of the pain that you experience in a normal recession. And that would get me to think, along with looking at the other data, fundamental, valuation, and technical, that we're closer to the bottom than we are the top. This is about what happens. The market already is discounting a mild recession, in other words. And if you look at the next slide, Katrina, we get at earnings too. And I just thought this would be a good exercise where we did the same thing. So everyone's saying average bear is down 40 and earnings decline more than 30%. Well, if you X out those horrible periods that I just mentioned, the average peak to trough decline in earnings is more like 17%. So it's, almost half of what is advertised. That people, if you get really fearful and you start thinking worst case, it's not that bad. And what's interesting about today, we're not in a recession yet. And earnings, which are coming out right now, are still positive. We're still looking for high single digit earnings growth. Now we're likely to get some revision to that, but so far so good. We'll see how that goes. And it just doesn't describe what you see not only around extreme recessions, nor so far what you would see around a mild recession. So let's keep perspective. Let's don't predict the predictors. Let's listen and watch the data and see where the trends are. That's what we're thinking. And that's why we say, hold tight. There's risk. Don't get aggressive and jump in, but hold tight. There's no reason to run.
Thanks. Switching gears a little bit, all everybody's hearing about right now in the financial news is all the concerns around inflation, particularly the 1970s style inflation and the rising risk of recession. So can you talk a little bit about like what is our take there, and why do we feel that it really isn't that bad?
Okay, so if you forward, this is our yoga chart that I refer to all the time. And if we ever come on here and you see a whole bunch of minuses, then I would say, I don't get it, Katrina and Jeff. You seem to be smiling, and it doesn't look like there's a lot to smile at. We've got all these headlines, coming at us too, just like you, about 4-decade high and inflation and supply chain bottlenecks, and what about those commodities and da 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 da. And so it's really nice to have a little sheet of paper that says, this is our map, what do things really look like? And it brings the blood pressure down. So we look at 3 levels of analysis in assessing the state of the union. We look at fundamental data, and you see all the subcategories there. How does the economy overall look? How are earnings trends? What about Fed policy? What about credit spreads? How much do investors demand to get in terms of their interest return on corporate bonds versus safer government bonds? So we look at valuation, and you see the different valuation metrics we look at. And then we look at the technicals. We look at not only sentiment. Investors will tell you if they're bearish or bullish, and that gets at sentiment. And it's actually contrarianly positive if investors are uber bearish and negative, which they are right now, because it says they've got a lot of cash on the sidelines that's ready to come in the market. If everyone's bullish, the last dollar's already in, and you can't make any money. So we look at sentiment, and then we look overall. Are stocks, even though they've weakened, are they still in a longer term uptrend? Overall, is the health, and momentum getting better or getting worse, and that type of thing. So we look at all 3. We rate all these subcategories as positive, neutral, or negative, and then we rate the 3 main categories of fundamentals, valuations, the technical, as positive, neutral, or negative. And right now we rate the fundamentals as neutral with a positive bias. It's not as healthy and as strong as we would have stated a year ago, but it's still supportive of being at your long-term target in equities. And if you do look at the economy, we've never had a major recession with unemployment at historic low levels. And so we've got consumers employed and spending. Retail sales data that just came out was solid. Industrial production is solid. Housing's softening, but it's not horrible. And there are other trends of some softening. Sentiment's not good because everyone's reading about inflation. But you want some of these things to soften, because that's what's going to bring inflation, and is bringing inflation in a little bit. We have too much demand for the supply that's out there. So anyway, fundamentals are neutral. Valuation actually has gone from 22 to 15 to 16, and that is reasonable and normal and average for periods where interest rates are about at these levels. Companies are way more profitable right now, and still, if you look at the earnings from stocks, they are well above the interest rate that you get on bonds. And that's a measure that folks look at. What's the earnings yield on stocks versus the interest yield on bonds? And right now, it is much more in favor of stocks than bonds. And then if you look at the technicals, again, I just said that things were, sentiment was bearish, and yet you still have stocks and longer term uptrends. And what we're finding is, in terms of the reason that we're not buy aggressively now, is that if you look at the percentage of stocks trading above the 250-day moving average, while it's very low, suggesting that we're getting to a bottom, historically at the horrible times, it has gotten a little worse. And we've also seen in recovery periods, in prior periods where we bottom, things getting a little bit better and seeing better momentum in the up days. Now, over the last month, we've seen growth stocks and technology and the kind of riskier consumer discretionary area of the market actually outperform, which has been great to see that kind of shift. We just need to see more of it before we feel comfortable saying, hey, we think it's time to add more to equities.
That makes sense. Do you want to now move into talk a little bit about the current wall of worry items?
I do. And I'm going to try. I've got just a little technology glitch here.
Do you not see my slides anymore?
I don't. Here we go. I'm going to fix it.
We're two peas in a pod with technology.
There we go.
Don't worry, everyone. We've got the investments covered. It's just the tech that gives us a struggle.
Yeah. So I'm back. Okay. I can see the slide.
Okay.
Yeah. So this is the wall worry slide. And in years past, and presentations past, we spent a fair amount of time on it. But this is the same wall of worry slide that we've shown going into the year in the crystal ball back in January. So it's not really changed. You see all the factors that are hitting the headlines, and we're going to attack a couple of these that are really the key. Not just don't take our word for it that we see less worse trends in some of these areas, but we examine each one of these. What we really care about is if it really starts to spill over and impact the things on the right-hand side of this table. If inflation and Fed policy and midterm elections, so on and so forth, really drive economic growth into negative territory, negatively impact employment in a very significant way, earnings start to really roll over at alarming levels and rates, and credit spreads start widening out and that kind of thing. And we just don't see this in such a way that would suggest we've got huge downside from here. And in fact, again, our conclusion is that you should be thinking about more, when is it time to be adding to my equity component as opposed to, gee, I need to sell. Mm-hmm. So I know we're going to address a couple of these, but this is just, again, a quick summary reminder of all the headline things that are out there that are worthy of knowing. And the question is, will they impact these other things in a really negative way?
Yeah. And I think to your point on honing in on some of them, I think the place to go next is to really hone in on inflation. The headlines, I know we keep hammering this home, but it's what the headlines are all talking about right now. But basically, saying it is worse than it's been in 40 years and it's getting even worse. You say it might not be good, but it's getting less worse. Can you reconcile that for folks that are tuning in today?
Yeah. Can I reconcile the headlines with, and you have Jeff and Katrina going public and saying, well, not really.
Yeah.
So here's just a little bit of the data that I think supports the idea. And actually, I think, Katrina, if you listen to the investment professionals on CNBC, on Bloomberg, on whatever your media du jour is, I think there's growing consensus that it is peaking, that it's getting less worse. Not as quickly as people want, but that it's not getting worse. So if you look at these four kind of graphs on this page, the one in the upper left is the personal consumption expenditure, or PCE, price index that the Fed keys on. This is what they really look at to help them conclude whether or not inflation's moving in the right direction. And you can see, while the headlines we've been reading is, it's getting worse, getting worse, getting worse, the PCE actually has stabilized a bit and fallen just a bit, eased just a bit. That's important. And then if you look at the producer price index, which is the price of raw materials paid for by companies, small business, and corporations. The PPI also has stabilized and started to come in just a little bit. Now, we're not reading about that, but that's what's going on. And then copper prices, look at that. They have really come in significantly. Lumber prices, I'm building a house, or I'm doing a renovation. And I was worried about, as I talked to the contractor, we're doing a couple extra things than we thought. And I thought, I'm going to get hit with a huge bill. And he goes, well, Jeff, I know staying on budget's important to you, but lumber prices have come in significantly. So there are other areas of gain. So, some of the things that drive inflationary pressures that are significant are coming in. And then if we look at the next slide, here we have a picture of average hourly earnings. And you can also see that this is not worsening. It doesn't look like, oh, great, boy, it's really eased. But this is what happens. Things get less bad. And before looking at the next slide, I just remind people that, we had a bottom in March of 2009 when the S&P was at 666 back in March of 2009. And, now we're at, we'll call it 3,900-ish. So that was a long time ago. But when the market bottomed, we were losing 700,000 jobs a month. Things were still absolutely not good, but they were getting less bad. And in ensuing months, in the midst of stress tests and still not knowing if banks were going to survive and so on and so forth, all of a sudden we started losing 600,000 jobs the next month, and then 500,000 jobs we lost the next month, until by the end of the year, we weren't gaining or losing jobs. And that's the same thing here with inflation. It's not going to go from 9.1% headline to 3 overnight. But if it goes from 9.1 to 8.5 to 7.6 to 6, that's what the stock market needs to see. And so those are the signs that we're looking for. And if you look at the next slide, also for perspective, I think that it's just been a knee-jerk reaction. We all do it. It's human nature. You go, oh my God, inflation's at 9%. Well, we are coming out of a pandemic. Supply chains are, very unusual. And we do have this war going on. It's not the normal cyclical thing. And inflation expectations for them to really get back to the 1970s type stuff. And that's what people seem just predisposed to automatically knee-jerk go to, this is 1970 or something. We went back and we looked at inflation. It's on this chart, inflation levels, and tried to, correlate that with Fed policy and what happened. And if you look at the 1950s, I'm not saying that there's a perfect parallel here or that there will be a perfect parallel, but there's a lot of similarities to that time period. And if you see in 1950-51, during the Korean War, we were just coming out of rebuilding in the immediate aftermath of World War II. We get pulled into the Korean War. Labor shortages were all about, and that was made worse by war. And so inflation jumped from 2% to 10% overnight, and the Fed had to hike a couple times. But that was the perfect formula. And you did have labor come back in. The Korean War wasn't World War II, and things self-corrected in a reasonable period of time. And the stock market did too, and went on to do very well. And we didn't have a recession until 54, 55. So there were several years down the pike. And you can see inflation moved up, but stayed in that kind of 5% range, and until the mid to late 60s. It took more than a decade before you had 70s style inflation. You had the Vietnam War, you had Nixon in 71, 72 coming out with wage price controls. You had whip inflation now from President Ford in 76. You had escalation clauses like crazy in unions that were very strong back then. And there was just this inflationary psychology. And then, hey, how about a couple oil embargoes to boot? And so before you know it, you were having to borrow at prime at 20%, and the Fed funds rate was close to that. it was in the teens. So this does not describe what was going on in the 70s. So again, let's don't predict the predictors. Let's see what happens. And if inflation's calming, then I think you have more of a kind of 1950s style. And maybe we'll build over the next decade into something not good, something like the 70s. We'll have to see as we move to this green technology that uses a lot more commodities. But I think this just provides some perspective where patience is warranted at this time.
Yeah, no, I think that's great context and perspective historically, how things have transpired. You mentioned the Fed. What about the Fed? Everyone thinks that they've gone mad, or at least are destined to cause a deep, dark recession. What's our take on that?
Yeah. So again, this is just like a perspective slide, and it shows you where Fed funds have traded over time, going back to the early 92 period. And in previous recessions, Fed funds rate was at 6%. Now, I could show you back in that 1970s era where it was high teens, but why beat a dead horse or pile on or anything. Here you can just see that Fed funds rate before we've had previous recessions, they were over 5%. We're at 1.75%, headed, and this isn't Jeff talking, this is Fed funds futures. Fed funds futures says that we'll be somewhere around 3.5% by end of year, but then it will be below that, somewhere around 3.25 deep into 2023. So Fed funds futures, that's the market. Those are investors who make financial bets on where the federal funds rate will be. And I don't want to make too much of that. That's volatile. It can change. But right now, the market's read also is that the Fed will likely be able to stop and not drive us to these levels that we see of 6% or so. We're not even to normal. And if the economy can't handle Fed funds of 3%, we're in a world of hurt. So I think this is just for perspective. It's not restrictive. We're moving to normal. If you look, there's another slide in here, Katrina.
Yep, I'm getting there.
There you go.
There we are.
So again, this does show you the Fed fund target back in 74 and 1981. There's where we show you they were 13% and 20%. We're nowhere near that. And it just really depends upon if we continue to see inflation calm, we won't get anywhere near that. And then this does show you the Fed funds, which I just mentioned, the Fed funds futures. You see how we're looking for by end of year, early 2023. And this is the market. These are investors talking, that they place probability of Fed funds being at just about 3.5% at the peak, and then rolling over into late 23 and 24. That's where we're at right now. That doesn't describe a significant recession and credit crunch.
And then I think next we just have a few slides in here.
Yeah.
You wanted to touch on regarding signs of recession.
Yeah. So I mentioned there were 4 things that we look at, and Bill and I are looking at these all the time, and they have deteriorated, but they're not screaming recession. So one of those factors is the index of manufacturing and non-manufacturing activity. Are manufacturing companies and service companies reporting growth in employment, growth in order backlogs, and so on and so forth, or decline? And you can see the manufacturing's in the blue, the non-manufacturing or service is in the red. And the rule of thumb, and you can see this in previous recessions, is that both of those move below 50, a reading of 50, before a recession ensues. Both of them have come in, but they're still in growth mode. So again, we don't predict the predictors. We watch this data. And before getting uber negative, you want to make sure that you're not premature. And there is a lag, before you actually see the recession. And in many times, the stock market decline has already occurred in advance of the recession, and the market half the time is up in the recession itself. So we've kind of suffered the pain. And so this is one of the factors that we look at. We have another one on the next slide. And this is the yield curve. And we hear everyone talk about the yield curve, and is it inverted or is it not? And there are two yield curves that we look at. The one on the left is the curve, the spread between this is the lower left, the 2-year bond and the 10-year bond. That is negative at this point in time. But very importantly, the spread between the 3-month bill and the 10-year is not negative. And before you generally see that recession, both turn negative, meaning the yield curve is actually below zero. So again, this is yellow flag, but it's not red flag. And then if we look, this is the index of leading indicators, and this shows you, the trend in the LEI. These are 10 different indicators. One is the stock market, one is industrial production, unemployment claims are another. And so there are 10 different components that are leading signs of where the economy's headed. They're still in positive mode. They've come down, but they're still in positive mode. And they tend to go negative in advance of the recessions, as you see in the gray bars here. So again, let's don't predict. Let's see where these head. And the final one is employment. And you can see how the red line, the unemployment rate, begins to move up and spike as we enter recession. And it right now it's pretty steady. So let's be careful of predicting. These are unemployment claims. Also in the red, it's the blue that I should have been focusing on as the unemployment rate. My bad. But my comments are the same.
Yes, you're good. You're good.
Yeah.
So that was a great kind of overview of some of those key factors that we're continuing to keep in mind as we look at recessionary risks. But we can't fail to bring politics into the discussion. So how do the upcoming midterm elections affect the markets, and what's our view there?
Yeah, there's kind of the big picture, and then there's always fun nuance. Some granular maybe thoughts or comments about it. The first point that I would make is that we always have greater drawdowns in the stock market in midterm election years. So on the left-hand side, this shows you in the blue what the peak to trough declines tend to be in the first year of a presidential election, the second year, which is the midterm election year, the third and the fourth. And you can see a minus 19%. So generally we get a 19% correction somewhere in the midst of the midterm election year. So I guess we're right on point, so far this year in that regard. And then this goes to show you what happens in the 1 year after election. You tend to get a bigger bump. And that's just, when you think about the rationale, and this is the granular comment, you tend to get wacky policy in the early goings of a midterm election year. You got this fight going on where people want to get legislation approved before the midterm elections because the party's going to lose power, maybe, and you generally get a shift in leadership in Congress. And so you get all this wacky legislation that happens. And the Fed, too, tends to do stuff early in the year, and then they want to say, hey, time out. We're not supposed to be political, so we really don't want to be political. We're not going to do anything. And that makes me think, number one, election activity is really dying down. We haven't gotten Build Back Better. We haven't gotten Build Back Small. And we got this guy in West Virginia who's creating all kinds of havoc in Congress, Joe Manchin. And so we're kind of at a standstill there. And the Fed also So we're hiking 50, then we hike 75. Now we're probably going to do another 75. And then they're likely to go, we don't want to influence the election. We want to stand back and just kind of see what happens. So what's normal on the right-hand side, you can see that in political election years, midterm election years, the market tends to trade flat to down all the way through late October. And then all of a sudden in November and December, you get the lift, because then you get people in there, you know what the agenda is going to be. Worst case fears are undone. The Fed's on hold, and you get this lift. And that happens over and over and over and over again. Different players, different people, different numbers in terms of who's leading by how much and all that stuff. But those are just things to think about from a political standpoint.
Yeah. You had mentioned earlier suggesting that clients should maintain their long-term strategic allocation to stocks, but not necessarily jump the gun and add to equity positions and increase their allocation modestly at this point.
Right.
I know this is partially based on our desire to see some more positive trend and progress on the inflation front that you talked about, but it's also based on our read of the technical price trends too. So can you hit on that for a moment? But keep it light since we're running up against the hour here.
Okay, I will. So, all right. We've just got some noise in here. It looks like an EKG probably, and maybe not a healthy one. I'm not a doctor. I don't think you are either, Katrina.
Probably what our heart rates have looked like lately.
Probably.
Everybody on this call, maybe.
There's a pulse. At least there's a pulse. So this is the sentiment, measure of sentiment. So it's, if you take the percentage of bulls and subtract from that the percentage of bears that are out there, either get a positive number or negative number. So if there's more bears than there are bulls, it's negative, and the blue lines are going down. You can see that they're going down in a big way. That is a positive, and generally the market will perform better. It's a good sign that there are a lot of skeptics out there, because that means there is a lot of cash to come in. Now, the reason we don't say, oh, sentiment's negative, buy, is one of the reasons is on the next slide. Here we look at a graph of the percent of stocks that are trading above their 200-day moving average in the red and their 50-day moving average in the blue. And what has occurred is that the percentages have fallen. And if you look at previous periods, I'm going to move stuff around here, but look back in March of 20, that's what you need to see. You need to see all this pessimism boil over and only a few stocks trading above their moving average. You saw that back in December of 18 too, that I managed. So we saw that happen, in June of this year, but it can get just a little worse. And so that's what makes us cautious. If the inflation news isn't lining up perfectly, if the Ukraine-Russia stuff isn't, resolved in any better than yesterday fashion, and importantly, if we don't see a lot of buying momentum. Now, the big change in the last couple of weeks has been this shift in leadership. Cryptocurrency has had a much better couple weeks here. Growth stocks, it's technology I mentioned before, and consumer discretionary stocks that have led. Energy is actually negative. Commodities and materials are negative. And that means that they're reacting to the fall in commodity prices and the stronger dollar. So that's a sign that we're getting risk-on attitudes back. But I would rather be, just a little more cautious in here. If you pared back to neutral, you went from 70 to 60, I'd rather buy in at 4,100, which is still down from 47.66, than I would buy in at 3,900 and run the risk of going to 35 before we go to our 4,500. So those are the thoughts.
Yeah, makes sense. So let's go ahead and move to wrap up, Jeff. What major thoughts do you want to leave with our listeners as tenets or words of wisdom during this challenging time in the market?
Yep. And I'll be really quick. And so here's a laundry list of things that we're trying to employ as an investment group, and that we hope that clients embrace. And that number one is, there's no value added in predicting the key metrics that give you a feel for where we're headed. Why would you predict an inverted yield curve? Why would you predict where the ISM is going to go? Let's just wait and see where these key signals are headed and what that trend feels like before making rash decisions either way, buy or sell. So patience is a virtue. We think, based upon the story that we just told you, that the most appropriate thing to do is to hold your ground and believe that we're closer to a bottom. Be poised to increase your equity exposure when we get confirmation that inflation continues to move in the right area and that the Fed is not going to have to hike as much as people fear in a worst case kind of situation. We do want to blend growth and value together. And over the last month, we're happy that we've done that. Stocks that are in that technology area that are high quality tech stocks, not the ones that don't have revenue, the ones that have good revenue and earnings growth, but they've been cut in half. And I could go on and on the stocks that we see that fit that bill. So we don't think long duration is dead. You hear this whole thing about, all these growth stocks that you don't make the money because they don't pay dividends until down the road. We love dividends, but we don't think 5G and electric vehicles and advanced driving and artificial intelligence and data and cloud, they're not dead. You need that stuff to drive productivity when wages are accelerating. So we think that you need to blend both your value and your growth, but focus on high quality in both camps. Active management can add significant money or value in an environment where you get this kind of disparity between stocks and where the Fed is hiking. So we always believe a nice blend of passively managed index investments as well as active management. And we think active management's in a pretty good place here in this environment. And bonds, when rates have come back up like they have, particularly individual bonds, higher quality, and you can get 3% if inflation's calming and coming in. You haven't been able to do that for quite some time. So particularly if the Fed has to stop hiking, bonds are beginning to look attractive for the first time in a long time as well. And we've got some charts. I just fast forward on this one. I don't think we need to cover that. I do the same thing here. I would just fast forward this on active management. The bar chart shows you the percent of active managers that outperform the S&P 500, the percentage of them that do that over various environments in various years. And notice that a fairly high percentage of them, 50% plus, 50 to 60%, outperform in those periods like 01 to 07 when the Fed was hiking. And that reverse course when we were in this environment from 08 until today, free money, and the Fed being at 0% interest rates and quantitative easing on top of that by buying bonds. We're going back to the 01-07 environment, folks. And so when that happens, stock selection can add value. We're pleased, we're very humble that so far this year that we're adding value through some active management, and there are great third-party managers as well that do that. So to have both active and passive in your portfolio can be value added. Yeah, I'm gonna leave it there.
Nope, thanks, Jeff. I do want to be respectful of folks' time. I do want to take the opportunity to just come back to this slide one more time as we close, and just to reiterate what we talked about earlier in the discussion today, that this really just illustrates why it pays to be cautious of embracing some of the negative thinking about the headlines. The S&P 500 is up 80% of the time. Corrections and steep corrections are a normal part of the market on an annual basis. We are in one now, and we totally understand that it tries the patience, but it is worth it to be patient. And there are times where one should be more cautious and adopt a negative view, although we believe that is rare and should be done when the data and the major indicators suggest doing so. And as Jeff said, earlier, we try to watch and listen to the economy and the market, not predict the predictors. I do know we had several questions come in. We really appreciate that participation. Given we are over the hour, we will follow up with or have your wealth advisor follow up with you on those answers after the webinar. But really just want to thank you for joining us today. Jeff, thank you for your participation in this discussion. We appreciate your confidence in us. It's been fun. It's always a fun time to meet you and talk about our outlook for the remainder of the year. And it's a privilege and an honor to be able to serve you.